and welcome to the preliminary results for the First Property Group plc announcement conference call. Today's conference is being recorded, and at this time I would like to turn the conference over to Ben Habib. Please go ahead.
Good morning, everyone. Thank you very much for attending our meeting on our annual results for the year to 31st March 2016. There will be time for questions at the end if anyone has any. There is a presentation that should be available on our website. For those of you on the telephone, those of you in the room obviously have a copy. And if you are on a telephone, I suggest you try and get access to the presentation because I will be speaking off it. I think it's under the investor section.
It's under the PLC tab, and it's the presentations. I think the subheading is presentations.
Presentations. Okay, so on the assumption that everyone's got access to it and understands what First Property Group does for a living, I'm going to start on page 5 of the presentation, just dealing with the highlights of the results. Revenue was up by 18.5% year to year. The main driver for the increase in revenue was the ownership of a number of investments that we made in the prior year for the full period of the year to 31st March 2016. Profits were down by about 9%, and the reason for that mainly, well, there are two principal reasons. The first was that in the year to 31st March 2015, we made about £4 million of one-off profits from trading office investments we'd made into Resi, and that was obviously trading profits which didn't recur to the full extent in the year to 31st March 2016. We did have some one-off profits in the year to 31st March 2016, but not to the same level as we did in the prior year. And we also had headwinds from a weaker euro during the year, which amounted to about £700,000 worth of pre-tax profit. So had we not had those variations, underlying profits for the year 31st March 2015 would have been closer to 4 million, and underlying profits for this year would have been more like 6.7 million. So the underlying performance of the group is markedly improved year to year. And for the year that we're now in, i.e. the year to 31st March 2017, you will see that again coming through. So from a visibility of earnings, security of earnings, actually the group is in a much better place than it was last year, even though apparently pre-tax profit is down slightly. Unfortunately, we have a sort of similar magnified issue with earnings per share, because we had a big tax credit in the year to 31st March 2015, which didn't come through again this year. So earnings per share were down even more than the pre-tax profit figure. But again, on an underlying basis, if you were to strip out the one-off effects, earnings per share would have been markedly up. And that's why we've increased our dividend by 11%. We've got greater visibility of earnings, security of cash flow, and therefore felt confident in increasing our dividend from 1.35 pence per share to 1.5 pence per share. Net assets ended the year at 34 million, but on an adjusted basis, when you take the market value of the properties that we hold into account rather than the book cost, which is how our net assets are struck, we had an adjusted net assets of about 43p, so 20% up from last year. And that's really a testimony to how well we bought the properties that we bought in the years 2014 and 2015. And also, and this is slightly bizarre, a stronger euro at the end of the year. So our earnings were hit because the euro was weak on average during the year, but at the end of the year the euro decided to strengthen, and so we ended the year with higher NAV than we might otherwise have expected. Cash balances during the year were down 26%, This was because we made a couple of investments in Romania, one in Romania, one in Poland, of about 3 million euros altogether, but also because in order to finance the Romanian investment, we lent the new company that we set up 6.5 million euros. That money has since been repaid to the group. So on a kind of pro forma basis, our cash at the year end would have been up by about 15% to 14 million pounds. So again, a very positive performance on cash when you think that we made two new investments with 3 million euros being deployed. Actually, cash on an underlying basis was up, which is a testimony to our cash generation capability as a group. Turning over the page, just to give a bit more detail on the properties we actually own ourselves. So we have on the balance sheet 134 million pounds worth of property at purchase price, with a market value of 156 million and debt secured on them of 114 million, which is an LTV of 73%. The LTV of 73% may set some hearts racing. It doesn't set my heart racing. Actually, I'd probably have a higher leverage level if I was given the opportunity. But I will just address the LTV later because I know that people in this post-credit crunch world are nervous of debt. So I will come back to that in some detail. Assets under management was up 8% during the year. We're very, very pleased with that 8% uplift. In the run-up to 2015, those of you who are familiar with the group will know that the question mark that was hanging over the group was what would happen to us once the USS mandate, which accounted at one point, it accounted for 80% of our assets under management. You know, what would happen to the group once that mandate expires? Actually, we've gone through the expiry of that mandate with earnings up and assets under management up. So we have navigated that extremely well, even though I say it myself. And we would expect AUM to continue to increase this year as we invest the rest of the shipbuilders mandate and as we make new investments. As a consequence of the shipbuilders mandate, which is a mandate for the UK, the proportion of assets we own in Poland has dropped. That's because the proportion of assets we've got in the UK has increased. It's not because we like Poland less. We're still focusing on Poland, but we've been investing more in the UK. We also like Romania. Not so easy to invest in Romania. The market is not as liquid as Poland, and there's a kind of standoff between buyers and sellers. But we have bought one portfolio of Lidl's in Romania, and if we can buy more at appropriately priced levels, we will do that. So just turning to page 7, and summary of the highlights. Assets under management, as I mentioned, up 8%. We extended the life of our UK fund, the first UK fund that we launched when we came back to the UK in 2010. That fund would have expired in February 2017. We've extended its life to February 2022, which indicates the contentment of the investors in that fund. We made 2 new investments during the year, one in Poland, one in Romania, worth a total of 35 million euros of property. Cash generation was good. Cash would have been up 15%, but for that loan that we made to the Romanian company, which has now been repaid, and our earnings visibility is much better. For the first time this year, we've published our weighted average unexpired fund management contract term, which is now 6 years, 6 months, and at the beginning of the year was 2 years, 10 months. So a market improvement there, largely as a result of the UK PPP fund being extended to 2022. Final dividend up, and then lastly another pat on the back from Investment Property Data Bank, which has rated us again the best performing fund manager in Central and Eastern Europe. We've held that position for all the years between 2008 to 2015. Turning to page 10, We give a breakdown of how NAV has moved over the last few years, and I think it's a very interesting chart. I'll say it again when we look at dividends, but it's very interesting that our NAV has gone up year in, year out throughout the credit crunch. And please bear in mind that we're a leveraged property investor / fund manager. So to have NAV growth throughout that period is remarkable. We haven't done any rights issue to save the company. We've been profitable throughout the credit crunch. And as you'll see in a moment, we've been paying increasing dividends throughout the credit crunch as well. The operating profit, just looking at page 11, the operating profit arising from group properties has increased materially through the over the last few years. We had a very significant contribution to our performance fees under the asset management side for the year of March 2015, which is at 4.44 million you see in the grey area. But this year we've seen, as I mentioned, the full year benefit of the investments we've been making coming through in group properties. And it's really the group property investments that from a profitability perspective have enabled us to circumnavigate the USS fund expiry. Page 12 sets out in greater detail how our asset management fees have varied. So big grey area, grey part of the bar. Grey is probably not a good colour to use because I have to refer to grey. But performance fee in March 2015, that's reduced in March 2016. When we look at the future, we assume no performance fees, but I think there will always be some, touch wood, performance fees in each year as we go forward, though probably not as large as the contribution that we had from it in March, for the year 31st March 2015. I'm not going to go through the chart on page 13 in detail, but what I'm very pleased by is that we were motivated to produce this chart. And the reason I'm pleased by that is that hitherto our business has been quite simple and quite dependent on 2 or 3 funds, most notably the USS fund. So we haven't been motivated to produce a chart that shows all the underlying movements. But our business has now grown. It's multi-dimensional in the nature of the assets we manage. And the fact that we've been motivated to produce this chart really should tell you that the business is much more broadly spread and a much better business, therefore, to be investing in than in prior years. And that is evidenced again on page 14, which used to be a much shorter page than it is now. We've effectively got 11 categories on page 14. And again, I don't intend to go through them line by line. You can do that at your leisure. The only point I suppose to make is that the SIPS Property Nominee Limited mandate was only about half invested at the year end. We're now about 88 million invested. And so we've got inbuilt growth in the company as we go forward and we invest that £125 million mandate. Page 15 gives you a breakdown of the group's earnings by client, assets under management by client, by category of client, and by geography. Page 16 gives you a more detailed breakdown of group properties. We own 76% of a company called Fprop Opportunities PLC, or Fprop. And we also own 6 properties directly, and this gives you the breakdown between the 6 properties we own directly and Fprop. You can see the direct investments. We consolidate Fprop, which is why we hold them under group properties, because we own 26% of it. But this gives you a better feeling for the underlying split. The 6 properties we own as a group are split in number equally between Poland and Romania. Book value, though, we have a hell of a lot more in Poland than we do in Romania. £75 million worth in the UK, in Poland, sorry, and 5.5 million in Romania. And therefore the contribution from Poland is much bigger. And I think it is just worth just noting for a moment that even though 51% of assets under management are based in Poland, the very large proportion of our profits is derived from Poland because the direct properties we own are principally in Poland. So looking at AUM and the percentage we have in the various countries we operate in is not really going to give you a proper representation of where we derive our earnings. You have to look at where we've got our direct properties. Our model for doing business is to own minority shares in our funds that we manage. So on page 18 we split out the proportion of the various minority shares we have in our various funds, together with the book value and current market value of those holdings, and the amount of money we've made from each of them during the year. We made very little from Fprop Romanian Supermarkets Limited and Fprop Galleria Corso Limited because they were bought at the tail end of the financial year, but they'll make a full contribution in the year that we're now in. Page 19 is a very necessary graph to look at now that we've bought so many properties ourselves. It's important for shareholders to understand how that contributes to our bottom line, not just from a profit perspective, but from a free cash perspective. So what page 19 does is set out the property performance of the 11 properties we hold, 6 directly and 5 via Fprop. So the total net operating income, so that's effectively rent less cost of operations of the properties we own, was 19.7 million euros. And we had bank interest cost of about 3.6 million euros, producing a net after bank interest net operating income of 16 million. Tax in Poland and Romania is quite low, so we paid a low amount of tax on those earnings of 1.25 million euros. Very significant debt amortization, so we are bringing our debt down. And when you judge whether we're a generous company from a dividend-paying perspective or not, you need to take debt amortization into account. It's not sufficient to just look at net profit and divide that by dividends, because now that we do own leveraged property, we do need to amortize debt. So you need to take our net profit and deduct from it our debt amortization to really get a feeling of the underlying cash flow that we produce. We do also have capex on our properties from time to time. It varies. I think the level of capex this year will be similar to last year. But we are also going to be expanding at some point fairly soon the shopping centre that Fprop owns in Poland, and that will be a level of capex of about 4 million euros. So you will see capex playing into our net free cash as well. And a lot of people looking at our dividend payment might conclude that we've got massive cover at about 3.5 times. But naturally, as a management team, we're looking at future investments, future capex, and debt amortization when we determine our dividend payment. And we've had to take all that into account. So we may not be overly generous, but we're certainly not mean in our dividend policy. Gross asset value of 197 million euros for the direct properties we own. And this is very interesting. So even at market value, the properties we own, and remember these properties are mature properties, they've been through the credit crisis, they've taken income reductions where they needed to take income reductions, they're still producing a 10% yield at market value. And so I'm just going to address the LTV point. Now, what stood us extremely well through the credit crunch, and I think will make sure these assets trade well going forward, is this very high yield. Where you've got leveraged property, it's not so much the proportion of leverage that you use as it is the amount of income that the asset's throwing off that determines what's safe and what isn't safe. I know a lot of property companies, or a number of property companies that went bust on 35% LTVs during the credit crunch, simply because they bought prime property with very low yields. So when capital values got decimated, they didn't have the yield there to protect themselves. Whereas, assuming we can maintain our yield, actually servicing this debt level is pretty straightforward. And please bear in mind that at the moment we are in negative interest rate territory in Europe. I don't want to get diverted by Brexit, but I think it's just worth noting that the European economy is a sick economy. Poland stands out and Romania stands out, but we are linked through the single market with a number of very sick economies in Europe. This produces an arbitrage opportunity for us as Poland, which is growing. So we can invest in high-yielding property in Romania and leverage extremely cost-effectively based on extremely low rates set by the European Central Bank. And the gap between our investment yield and our borrowing is very large at the moment. So we are throwing off very high rates of return on these properties. And through that very high rate of return, we also derive confidence that our debt levels are not high. But just to be very safe, we hold each investment in a different company, ring-fenced, so that one property going sour won't bring the whole house down. We have no guarantees provided by the group company for any one of these subsidiaries. So everything's non-recourse. And we do also fix and have fixed a proportion of the interest rate on each of the loans. We used to have a policy of buying interest rate caps, but I think with interest rates where they are now, it's a kind of no-brainer to fix interest rates. So on the Romanian properties that we've just bought and financed, we fix the interest rate on the entire loan for a 6-year period at 0.18%. Now, that's an unprecedented 6-year fix in my working life. And what the central banks are telling us is, they want us to borrow money, so we're obliging. And we've got a weighted average unexpired lease term in our portfolio of 4 years. That may look low from a UK perspective, but actually from a Polish perspective, where market standard leases are about 5 years, 4 years is a good vault. And we had a vacancy rate of about 2.4% at year end. That's since come down. It's probably around 1% at the moment. So a very healthy portfolio. And I've got no particular worries about the portfolio going forward. Naturally, we have lease expiries where we're going to have to release properties. Naturally, there'll be some tenants that suffer going forward, given the nature of the business that we are now. But, by and large, it's a secure income stream as far as we're concerned. They may bob up and down as we go forward, but we're confident in it. I'm going to skip page 20, which, we've dwelt on one way or another, but 21 sets out the top 10 exposures we have in our portfolio, and that too should give you comfort, because Asseco is the largest Warsaw Stock Exchange listed software manufacturer and maintenance provider in Poland. It has significant contracts with the Polish government, very large company. It accounts for 27% of the income in our directly held properties. Citibank, Carrefour, don't need to be explained. Aquila is the largest logistics company in Romania. Skanska, again, you'll know. Tesco, you know. OLPP is a Polish operator. Logiczni, Paliw Plisnicz is a Polish government institution. Narodowego Funduszu Rozwoju, NFZ as we know it, is the Polish security. They manage the payment of social security in Poland, another government-owned entity. Bank Zachodni WBK is owned by Santander, and HRK is a medium-sized business. So, actually our top 10 covenants, which account for 72% of our income, are fairly blue chip. Not all of them are blue chip, but they're fairly blue chip. We're just going to look at the dividend again. And I've touched on this, a bit of backslapping, self-backslapping, but ever since we started paying dividends in 2003, we've done nothing other than either maintain or increase dividends, including during the credit crunch. Obviously, the rate of increase slowed during the credit crunch, but now that we're emerging from it, and in particular having emerged from the USS expiry, the potential expiry of that mandate, we've taken a much more robust approach to increasing our dividend payout. So you can, that's a fantastic graph. I don't think we're unique as a property company in continuing to pay a rising dividend stream through the credit crunch, but that must put us in a fairly rarefied atmosphere. Then just turning to the markets in which we operate, Poland is doing extremely well. GDP growth is around 4% per annum. Wage growth is terrific. Consumer spending is rising. Unemployment is record low. Government debt levels as a proportion of GDP is low. All the macroeconomic fundamentals are great. There's been an overdevelopment of offices in Warsaw, but we're well aware of that, and we would only restrict ourselves to buying properties where we think rents are set at a level that is defensible. There's also been an overdevelopment of retail property across the country, but again, we're aware of that, and we will only buy retail property where we think the asset has a dominant position and cannot be outpositioned by a new development. Buying retail property in Poland is where we want to target our efforts, because the consumer there is getting richer and richer. I suppose the only potential wart for Poland, and it is a significant wart if the risks come home to roost, are the policies of the new populist government that was elected there in October 2015. It did some fairly commercially inastute things after taking office, fairly naive things, I think, which resulted in S&P downgrading Poland from A- to BBB+. That downgrading came as a shock, not just to ourselves on the investment, in the investment community, but I think it was a huge shock to the Polish government. I don't think they anticipated that their policies would result in a downgrade. Poland had gone through the credit crunch, holding its credit rating. So within 2 months of taking office, they managed to get a downgrade, which was shocking. And I think that has chastened the government, and they seem now to be rowing back from some of their more extreme moves. But we're obviously watching that space carefully. It's not the first time they've been in power, this government. They held office between 2005 and 2007. This party held office between 2005 and 2007. They didn't do anything particularly mad in those years. So we're hoping that, having been chastened, they will now act with at least half an eye on what the investment community thinks of them. Romania shares a lot of the positive macroeconomic numbers that Poland has. So GDP growth at 4%, wages growing, unemployment dropping, government debt very low, 38% of GDP, very low government debt. Bizarrely, Bulgaria also has a very low government debt. You wouldn't think it. The conception of the Bulgarian economy is not one of fiscal rectitude, but they are more fiscally prudent than we are in the United Kingdom. And the only drawback, I think, with Romania, and I think it's what Michael Gove meant when he talked about the European Union hollowing out communities, the only drawback with Romania is a decreasing population, because people are leaving Romania to work in the United Kingdom and Western economies. And, they're not alone. It's happening in Italy, Spain, and a number of other countries. So the European Union single market has actually worked against countries like Romania from a population perspective. It is having an adverse effect on populations, and obviously that has long-term effects on GDP, etc. But it is nevertheless still growing quite fast. Of course, GDP per capita is rising even faster than the 4.2% total because, the population is dropping. But the challenge for some of these countries is going to be balancing their populations. In Poland now, one of the populist moves this government's made is to remunerate all mothers who have a second child and every child thereafter with 500 zlotys a month. So the message from the government clearly is go out and procreate, and that's a good message for Poland. They don't want to balance their diminishing populations with immigration. They're very anti, and this is another interesting point about the EU, but they're very anti the German-led influx of immigrants from Syria and Turkey, etc. So when Poland was asked to take 4,000 Syrian refugees, the answer was a blanket no, unless they're Christian. We are seeing swings to the right. I think one of the reasons for the swing to the right in Poland may be slightly different to Austria, where there was a very serious swing to the right, and we've seen swings to the right in Germany and France, etc. But, this immigration issue does play strong in Central and Eastern Europe, and they want to grow their own populations. They don't want immigrants, and I think that is, partly why we're seeing these political swings. In Greece, it was a swing to the left, but in some other parts, it's been a swing to the right. And again, I don't want to be diverted by Brexit, but the single market has come to be seen as invoking a concept of the level playing field in amongst all these countries, but of course it's anything but a level playing field. What it is doing is saving Germany's exports and surpluses to the detriment of these deficit-running countries. And the only way they can balance their economies is through internal deflation, because they can't weaken their currencies, they're all stuck in the euro. And of course deflation internally is a very dangerous thing because it leads to unemployment, and unemployment leads to civil strife, and civil strife leads to extreme political swings, and extreme political swings can lead to war. So unlike David Cameron, I disagree that Brexit would result in a third world war. I think the continued existence of the single market as it's currently structured is more like, I have really got diverted by Brexit, but I thought I'd just say all of that. But we don't think Brexit is bad for the UK. We think Brexit would be terrific for the UK. We'd be free of the shackles of the single market, and we could spread our wings as an economy, trading with the rest of the world. So any volatility that occurs on the back of a Brexit vote would be welcomed by First Property Group. We would pile into the markets. Naturally also, a weakness in sterling following a Brexit vote would mean that all our European-denominated assets would go up in value. So we'd have a really good opportunity there to capitalize on some increased value in sterling terms. But actually, we think that any short-term sterling weakness would result in an even better UK economy as people pile more money into the UK. So we're completely sanguine about the prospects for the UK economy outside the European Union. If we stay in the European Union, we'll go on growing. It won't be as I don't think we'll have the same growth that we would have if we left. I stand against the OECD, IMF, George Osborne, and everyone else when I say that. But I'm pretty confident in my position. So just looking forward, we've got the sixth mandate to invest, so we've got inbuilt growth in the group. We've got a cash pile of 14 million, which we're going to invest in new funds as we go forward. Interest rates are going to be low for the foreseeable future. We're going to be able to buy high-yielding assets going forward. So we are very excited about where we are at the moment and our future prospects. So having said all of that, I think I've kind of exhausted the results presentation and would like to open it up to questions now, please. Any questions on the telephone?
If you would like to ask a question at this time, please press the digit 1 on your telephone, followed by the star. Please ensure that the mute function on your phone is turned off to allow your signal to reach our equipment. And a voice prompt on your phone line will indicate when your line is open to ask your question. Again, please press star 1 to ask your question. We'll pause for a moment to allow people to queue.
Any questions in the room while we pause for the telephone?
Yeah. I think you've done a very excellent presentation, and I think the market should accept the growth that you're representing. My question is simply Romania, where I used to work and live. How was the valuation done of your properties there, and have you contacted Europa Capital, who I had a meeting with yesterday, actually, who have some properties that may be for sale? And the question is, what kind of properties are you looking for in Romania?
Yeah, so, I mean, valuation is a really interesting point about Romania. There's, the liquidity in the market is very low by comparison to Poland and obviously to the UK. If you talk to agents, basically they say prime property trades at 7%, and I think sort of uber prime property, like the brandest, newest, Class A, well-located office block, probably does trade at 7%, and there are German institutional buyers who will pay that to buy that product. But then but we don't buy that kind of, we're not into prime Class A property. Then there's a whole plethora of office blocks across Bucharest that every vendor wants 8% for. 8% makes no sense for a buyer because an 8% yield is not capable of being sustained by the bank margin that lenders want. They want about a 4% margin over Euribor, and then they want about 4% per annum amortization. So you've got no free cash coming off your investment at 8%. And there's no shortage of office blocks in Bucharest. They keep developing more, and as you probably know, Pepera is overdeveloped substantially already. So there's a very high vacancy rate in Pepera. And people keep saying, well, Pepera doesn't weigh on the Bucharest market, it's a different sub-market. But I disagree. I think it'll particularly come to bear on the Bucharest office market once the north, because Pepera is in the north, once the road links to Pepera are finished, and they're being built at the moment. So I think it'll bring all of that. So I think Bucharest offices is dangerous, and it's not dissimilar to Warsaw. One of the common factors in Central and Eastern Europe, and particularly between Bucharest and Warsaw, is that you've got a flat topography with no real geographic limitations to where you can build, and the planning system's pretty fluid, so you can just go on building. And so we're nervous of office blocks, other than in the heart of the central business district, where, if we are buying them, rents have already been reset, and we don't want new buildings where rents can only go down. We want to buy buildings where obsolescence, to the extent that it's going to take place, has taken place. But what we really want to buy is retail property, because the consumer's getting stronger. Now, the Polish population's steady. You're getting quite a lot of movement from the regions to Warsaw. So you've got to be quite careful in which part of Poland you buy your shopping centre, because you don't want to end up buying a region where the population is moving to Warsaw. Broadly, Western Poland is secure from a population perspective, and Eastern Poland is under pressure. So you want to buy in Western Poland. Obviously, retail property in Warsaw is fantastic to buy if you can buy it, because the population of Warsaw is going up, and Warsaw is the engine of growth of the Polish economy. Bucharest, similarly, if you can buy well-located retail in Bucharest, terrific. Again, a lot of what we've looked at is overpriced, but these Lidls we bought, and we bought them in regional towns where populations have been reducing. So we bought them advisedly. We bought them on an 11.25% yield. So we can take hits on the rent there before before we begin to suffer.
Have you looked at Cluj and Timișoara?
Yeah, we have, and we've got stuff in Cluj and Timișoara, and we've got stuff in Ploiești. We've also got stuff in places you would never have heard of, Salonta, Piatra Neamt. You probably know these, having lived in Romania, you probably know them. But Most people haven't heard of them. And the key for us is, being opportunistic buyers of property, the key for us is the property we're buying capable of being sustained, the retail property we're buying capable of being sustained by the local population. Now, you have got this population shift, and you don't know where that's going to end up. But GDP growth per capita is rising, so spending is rising. The other thing that the Romanian government did last year, which was very advantageous to us, was to cut VAT on food sales. I don't know if you saw that. But they cut VAT on food sales from 24% to 9%. And that was an infusion of profitability into the retailers. And that has underpinned, I think, rents in the food retailing sector in Romania. With this very strong fiscal position that Romania's got, it's able to, pump more money into the economy. Poland has got low debt to GDP, but it's 52%, and they have a cap at 50, constitutional cap at 55. So their hands are more tied than Romania's is. So yeah, we like Romania. We step very carefully around valuations because we know that they're pretty artificial. What we look at is what return can we make on our equity. Are we happy with our return? And we wouldn't buy anything in Romania if we weren't making a 15 to 20% minimum rate of return on equity year in, year out from the rent. That's really our driving factor. Any other questions in the room? Anything on the telephone?
There are no questions in the queue at this time.
Great. Well, if there are no further questions, thank you very much, everyone, for attending, and I look forward to seeing you at the half-year results in, is it December, George?
November, isn't it?
November, November, Great, Thank you very much.
Thank you, ladies and gentlemen. That will conclude today's call. You may now all disconnect.